Okay, so we're on module 3 here. And so the first thing is that, especially with this module, right, I will put like a star by many of the topics because they sometimes do vary by the state. So if we were talking about interest rates, right, and cash values and borrowing against the cash value, we might sometimes see, right, there's a difference in interest rate, right, between states. So that's just something that I might want to go back to review with our Excel course to get the most accurate percentage, which is something that you do want to know. But I will bring that up along the way as well. So when we're taking a look at these riders, provisions, and exclusions, first I want to think about like the general definitions, right? So with the riders, these are added on to an existing life insurance policy. So hopefully we know about, right, some of these policies like whole life, right, universal life, indexed universal life, variable universal life. And we see how with these riders, the purpose is that they tailor the policy to the policyholder's needs. And so, right, we can see that there's the cost of living rider, we have the guaranteed insurability riders, we also have the waiver of premium rider, and we'll take a look at all of that in just a moment. But whenever, right, we add a rider, right, we might want to think about how the premiums or the cost for the insured is going to change, right? And so whenever a rider is added, the premiums will increase, right, per month, right? Or if they're paying quarterly, it will increase quarterly. Because, right, riders, they provide extra coverage, right? So that would entail an increase in premiums. So it might have been without the rider, maybe 800 a month. But now with the rider, it might now be 900 a month. And it really just depends on the policy as well. Now, provisions are these standard terms and conditions, right? So provisions are in a contract, right? So it might be, for example, we'll talk about the free look period, right? We'll talk about some of the other provisions, but these are just the standard terms within the contract. So when we take a look at some of these riders, the first one we want to take a look at is our waiver of premium rider. So this allows the policyholder to stop paying premiums if they become totally disabled. So the purpose of this rider is to provide one, right, with the opportunity to still be covered even if they're unable to pay premiums. Now, one condition, as I mentioned, is that they have to become totally disabled, right? And there's usually a waiting period as well, okay? But when we just think about waiver of premium, we want to relate that to, right, disability, full disability, and a policy that still remains in force, right? A policy that still remains in force regardless. Now, when we take a look at our second policy rider, we're talking about the guaranteed insurability. And so this allows one to purchase additional amounts of insurance at specified times or life events without providing evidence of insurability. So here, right, the key is that the policyholder can purchase additional amounts of insurance without providing any medical report, right? As well, right? They don't need to meet any of those requirements for that. And this can be during, right, birth of a child. This can be also at specific ages as well, right? It can also be at specific ages in which one can purchase additional amounts of insurance. And it really depends on the policy, right? The policy will specify if this rider is available. And if it is, right, what are the specific policies related to this rider here? All right. So besides from our waiver of premium and our guaranteed insurability rider, we also have the payer benefit rider. So the payer benefit rider is mainly attached to juvenile policies. Okay, so this is a rider that often confuses test takers because it's something that is a little more unique. And so when we think about the payer benefit rider, we might be thinking about, right, it's attached to the payer, but it's actually attached to the insured, right, the person who's not responsible for paying it, right, the juvenile. And so if the payer in this case passes away, right, so if the guardian, right, or the parent passes away, then what happens to the juvenile life insurance policy? Well, in most cases, right, this rider allows this juvenile or this child to still be insured, right, until a certain age, even if the guardian or the parent, right, or the payer passes away. And so, right, this allows the child to still be insured, right, to still be insured under this life insurance policy, right, up to a certain age. So we'll really highlight this, right? It's attached to juvenile life insurance policies. Okay. We also have our accidental death and dismemberment riders, right? So this rider provides an additional death benefit if the insured dies as a result of an accident, right? So that would be called also a principal sum. If there is a serious injury, right, like a dismemberment, then this rider also provides benefits, right? And that's called a capital sum. Right? So a dismemberment would be like a loss of limbs, or eyesight. Right? And usually they will specify, right, that this dismemberment has to be like a complete loss of limbs rather than like just medical injuries, right? This is due to a serious injury that causes a loss of like an arm, right? Amputation of some sort. Okay. So there are like specific eligibilities, right, that have to be met before there is a benefit. And again, right, with the riders, right, usually it's pays out benefits in addition to the policy death benefit, right? That's why we do have riders, right? Riders add on, right? Add on additional coverage, right? So you'll see when you start to hold appointments and negotiate with clients and you illustrate, right, the policies, you'll see, right, you have a column that mentions, right, how much the rider will provide, and you also have a column of the death benefit too. So it's added on, right? The amount it will be is added on to the death benefit. And we also have our term riders. So we've already saw, right, term life insurance policies, right, that are temporary. And term riders are very similar, right? But they're added on to a whole life policy. So maybe we might have to travel abroad for a period of time, right? Or we might have to be working in a dangerous occupation for a period of time. And might need additional coverage during that time, right? And so a term rider is a add-on, right, to an existing life insurance policy that allows one to hold extended or expanded coverage for a specific time. Okay. So far, most of these are pretty self-explanatory, but we do want to kind of know some terminology, right, some conditions in which that have to be met, right, in order for the riders to pay out benefits. Okay. Now, another rider that we have, or we can see, is the other insured rider, right? So oftentimes we have individuals hold a policy, but they also might want to expand this policy's coverage to others, right? So no matter if it's in a business situation, you might have it, you might want to also cover your business partners. If it's, I think, for a personal situation, right? You might also want policy to cover the spouse, right? The child. And so this rider allows that. We also have our long-term care rider. In just a moment, we'll take a look at specifically the different types of long-term care because long-term care itself is a policy, right? Long-term care itself can also be a policy, but we also have long-term care riders. We also have long-term care riders. So what this means is that, remember, a rider is an add-on to benefits, but a policy itself is like a standalone policy. But now we're just focusing on the rider. So this rider provides add-on benefits if the insured requires long-term care services. And in the next few topics, we'll take a look at what these services are. We'll take a deep dive into eligibility requirements of receiving long-term care benefits. But right, we know that nursing homes, we have home health care, right, the use of medical personnel, right, in that case. And what happens is this allows the policyholder to access a portion of their death benefit earlier to cover these costs, right? So it allows one to access one's death benefit earlier, which is often something that, right, is not allowed. But in this case, if we have this rider, we can see that it provides one with comfort that they know that, okay, well, I'll have enough to cover these expenses, right? Long-term care expenses. Okay. And then our last three riders that we want to take a look at include our return of premium rider, okay, which states that in the event of the death of the insured, right, within a period of time, the policy will pay, in addition to the death benefit, right, the amount equal to the sum of all premiums paid to date, right? So it's going to pay back maybe a year's worth of premiums that you paid. But remember, with these riders, there's always some eligibility requirement, right? And so in this case, it's that the insured has to pass away within a specified period of time, right? Because if it's like 50 years, then that's just a regular policy, right? But this return of premium rider is usually just apply for maybe a couple of years, right? It's just a rider that is only eligible during that time. All right, now we have the ninth rider, which is our disability income rider. So we also have our disability income policies, right? But we also see that with insurance, right? We also like to pair it sometimes with riders, right? We're like can convert a standalone policy to a rider that can be added on, right, to life insurance. So disability income rider allows one to receive regular income if the insured becomes disabled. But qualification is that they usually have to become totally disabled. And again, right, the benefit and the amount depends on the rider, on the terms. So in this case, right, one is able to receive some benefits of life insurance, right? But also some benefits of like health insurance too, right? And then with our 10th rider, that's the cost of living rider. And this is often, it's really common nowadays with these life insurance policies because of inflation, right? Cost of living is increasing. And so what happens is that $1 million of face value now might be different from in the future, right? 1 million now might be a lot less, right? It might be worth a lot less in the future. So even if, I work with a client and we decide on a $1 million face value policy, right? Well, in 50 years, that might not be worth much, okay? But the cost of living rider, right, constantly adjusts the death benefit to keep pace with inflation. So your death benefit might actually increase year to year because of inflation. And it's calculated through the CPI, which is more of an economics thing with the cost price index or consumer price index, or some predetermined percentage. Okay, so now we want to practice on using what we've just talked about with writers and try and pair it with what we know about life insurance. And so this will give us practice into really knowing what is a rider, right? And the roles it plays. So let's look at a scenario first. So Jessica, a 30-year-old teacher, and her husband, Mark, a 34-year-old software developer, have two young children. They're concerned about ensuring their family's financial stability if something were to happen to them, as they work dangerous jobs. Let's pretend, right, they're working in dangerous situations. They also want the flexibility to adjust their coverage as their financial situation and family needs change over time. Okay. So we want to think about, right, a appropriate policy, right? What is an appropriate policy? Well, we see that they want adjusted coverage, right? So that means that we would gear towards like a universal type policy, right? Because with universal life, right, the death benefit can be adjusted, right? With ordinary whole life, it's fixed, right? So most likely we're gearing towards like universal life insurance. And with the rider, right, well, they want to ensure that they are financially stable, right? If something were to happen to them, right, as they work dangerous jobs. Let's pretend it's dangerous. So what happens? Well, an appropriate rider could possibly write the accidental death and dismemberment rider, right? That would provide benefits, right? If, for example, the husband Mark, right, passes away due to accidental death, right? In that case. Okay. So we just want to kind of think about some ways to kind of practice, right? Think about, oh, we have this policy, we're adding on the rider. Okay. All right. So this is our first scenario here. We just have a couple of scenarios. And in this one, right, we have Michael, a 55-year-old CFO, is nearing retirement and has accumulated significant assets. He wants to pay off the premiums immediately to purchase a new insurance policy. He also wants to ensure his estate is well managed and that his family is financially secure now and after his passing. And that inflation does it impact the purchasing power of the death benefits. So let's take a moment and take a look. Based on the scenario, what would be an appropriate policy and what would be an appropriate rider that would be added onto that? And then we'll go over it in a moment. All right. So for this one, we're taking a look at the policy first. So if we see that he wants to pay off the premiums immediately, right, that would be a single pay whole life, no matter what, right? Because we're looking for that lump sum payment that we've talked about before with life insurance. And the rider, right, what we just talked about in this topic, right, we're taking a look at the cost of living rider would be most appropriate, right? Because he wants to make sure that inflation doesn't impact the purchasing power. Right. All right. So now let's look at this second situation here. Sarah, a 35-year-old single mother, has recently given birth to her first child. She is currently low on cash, but is expected to return to work and earn more in the future. She's a primary breadwinner and wants to ensure her child is financially secure if something happens to her. Sarah is also interested in securing future coverage options for her child. Okay, so let's take a look at which policy and which rider best suits Sarah's needs. Okay, so for this one here, the most appropriate policy is the modified whole life insurance, right? So we've seen that with the modified whole life, it's where, right, the premiums are usually lower in the beginning, then there's that one-time change, right, to increase the premiums, right? And we can see that Sarah, right, is currently low on cash, but it's expected to earn more. Now, for the rider, right, we see that her primary interest is to secure, right, coverage for a child, right? So that would be a payer rider. Remember, payer riders are usually attached to these juvenile, right, these juvenile policies. Okay. All right. And then this is one more scenario here. So let's take a look at Dan, a 35-year-old construction worker who works in a physically demanding and high-risk environment for only the next 2 years. He wants to purchase an insurance policy with flexible premiums and death benefits, while investing his cash value in separate accounts. He's married with 2 young children and wants to ensure that his family is also covered. Okay, so for this one here, we would have the appropriate policy being the variable universal life, right? So we know that he wants an insurance policy with flexible premiums, right, and death benefit, and investing in separate cash values, right? So that would correspond to the variable part. And the rider would be this other insured rider, right? He also wants to ensure that his family is also covered. Okay. All right.